Given the rise of precious metal prices during the summer, there was a lot of talk about the gold-silver ratio, but what does this actually mean and how can traders use it to try and profit? Hello, I'm David Jones from Capital.com and I thought we'd take a quick look at the gold-silver ratio. You know, we saw a lot of activity in precious metals, strong moves by gold and silver this year, and some talk about this gold-silver ratio being at important historical levels. But what actually is the ratio and how can we use it if we're an investor or a trader? I'm going to talk about this in a second, but first of all, let's just have a very quick catch-up with what was going on with gold and silver over recent months. Just one thing, of course, if you're watching the video and you haven't subscribed, click on subscribe down there, support the channel, and we can continue to push out content like this. Let's take a quick look at these two markets, then I'll talk about the ratio in a bit more detail. So this is gold. We saw this great run this year for gold in July, pushing out to about $14.40 an ounce. And if we step the chart out and take a look at a weekly chart, you can see this is the highest it's been in more than 6 years. So you'd expect the July reading for gold-silver ratio to be quite high. We'll take a look in a second. Let's have a quick catch up with silver. And here's the chart for silver. Here's July here trading around about 15.20. So it had recovered, but nowhere near as strongly as gold. So you'd expect that to have an impact on the ratio. Let's find out about this ratio now. Then I'll come back and look at things in a bit more detail. So let's get back to the ratio. What does it actually mean? Well, put simply, it's how many ounces of silver are required to buy 1 ounce of gold. It's a simple maths division. So as an example, if gold is trading at $1,500 an ounce and silver is trading at $15 an ounce, then this gold-silver ratio is 100. 1,500 divided by 15. It's as straightforward as that. Of course, gold and silver tend to move in sync. You know, they're the same group, the precious metals group, and traders and investors will use the gold and silver ratio at extremes. If it's gone too far one way or the other, they'll look to maybe sell or buy gold, to sell or buy silver. Let's have a look at some historical important levels for the gold-silver ratio. So on the upside, the largest extreme in recent decades has been up at 100. That was hit in February 1991. So you required 100 ounces of silver to buy just 1 ounce of gold. That was seen as an extreme reading. And that's why during the summer, we saw a lot of talk about this ratio because it was trading up at 93. So it was showing a pretty extreme reading based on what we've seen over pretty much the last 30 years or so. We'll take a look at it on the chart in a minute. So that was a pretty extreme number for the gold-silver ratio. So on the downside, some more recent lows, 66 in August 2016. And before that, we need to go back to April 2011, where it took just 33 ounces of silver to buy 1 ounce of gold. The historical average over the last 30 years has been around 60. So moves away from this sort of median middle ground may present opportunities to traders. At the moment, the ratio is trading around about 84. So still well above that historical 30-year average, but clearly off those highs that we saw in the summer. Let's take a look at the chart, that historical high of 93 back in the summer, and see how the markets reacted. So you'll remember that in July of this year, the gold-silver ratio hit 93. Traditionally, that would suggest that perhaps gold and silver are out of sync. Perhaps it's time to sell gold and buy some silver if you're using it that way. That did actually play out pretty well. You know, if we go back to July for silver and look on the chart, we did see the price of silver gain about $4 into early September. So a move in excess of 20%, and we saw that gold-silver ratio get more normalized back to where it's trading now, around about the 84 mark. So that's one way where it did work, where we saw the ratio hit an extreme. Gold maybe lagged a bit, but silver then caught up. So that's one way where the ratio trade did play out. So you can see the extreme reading there. When the ratio was pushing towards 100, we did see silver play catch up, and play catch up quite drastically. So selling out of gold and buying into silver would have worked back then. It's important, of course, to state that it doesn't work all the time, and these bands, they can change. You know, we could see the ratio push through 100, or even, you know, fall below 50-40. It doesn't mean these bands are absolutely set in stone, but when people are talking about the gold-silver ratio, this is what they're talking about, and they will use these historical extremes to switch their exposure from one metal to another, perceiving one as expensive and one as cheap. I hope this brief explanation of the gold-silver ratio is useful. Of course, we do regular monthly analysis of gold and silver plus other markets on our channel. So to never miss out, just make sure you're subscribed, and if you click the notification alarm bell down there, you get a message off YouTube every time we upload new content. But for this quick look at the gold-silver ratio, we'll leave it there. So from me, David Jones and Capital.com, good luck with your trading.